Hello and welcome back to Building Freedom. My name is Hans Nielsen and today we are going to talk about Dividend Aristocrats. As you might recall, this channel is all about building financial freedom. It is about finding some ways to get a good, decent performance on our money, and we want to do that without working too much. It's not that it has to be completely passive, but it shouldn't be 24/7 in front of a screen. So Dividend Aristocrats, it might be the way to go. And I will investigate a bit further into that today. What we're going to look at today is, as you can see, what is dividend? Why is that important? We should look at what is Dividend Aristocrats, why do they perform, how can we invest in them automatically or actively, and we should also look just very briefly at something called Dividend Kings and Champions, which is a couple of variations here. But basically, we want this to be as passively as possible. So at the end of this video, I will give you the exact way that you can put your money into this strategy and maybe make a decent return. But first of all, let's have a look at the dividends, just if you are completely new to that concept. I found this description of it. Dividend is a distribution to shareholders out of profit or reserve available for this purpose. Basically, what dividends is that we have a company making some money. And let's just have a look at it for, we have AT&T here that I have found that is one of the companies that have paid out dividends for a very long time. Now, a company earns what was called EPS, earnings per share, meaning that they have their profit for the year and that is divided by the number of stocks they have in the market. So EPS stands for earnings per share. Now, out of that earnings per share, the money that the company earned, they can choose to do different things with them. They can buy back some of their stocks, they can invest in some research or new factories, or they can make us shareholders happy. And they can do that by pay out dividend. And that is a portion of the profit. Here we can see dividends per share. That is a number of dollars, meaning that if you have 100 AT&T shares, you're getting just around $2 per share here in AT&T, meaning you're getting $200 each time they pay out dividends. And down here, we can see that the dividend yield, meaning that if you bought the stock right now and you would be to get the same dividend measured in dollars, that would give you a dividend yield of just above 5%. So that is the dividend. The dividend is money paid out of, as it says here, the company's profit or reserves they have in the bank account or otherwise available for this purpose. Very good. Now, why is that important? Well, there are several different points here that dividend investors really like. And I can't understand why. If you're looking at YouTube over the last year or two, dividend investing has become huge. Everybody's starting their own YouTube channel where they're showing the portfolio and how much they earn in passive income and so on. And what people often focus at here is point number one: dividends are actual income, money in the hand. Some would argue that that doesn't really matter because otherwise the money would just be put in the company and be put to work inside the company. And that is true. But if you are investing to get a constant flow of passive income, then this can actually be quite nice because a lot of US companies are paying dividends out every quarter, so you're getting a fixed amount every quarter, as long as, of course, as the company keeps paying dividends. So this is money in the hand that you can use to pay your rent or food or whatever with. Or it can, of course, as point number two here, be reinvested to buy more shares in this company or in other dividend-paying companies. So it can be used for whatever you want to. The dividends can also lower your risk. And that is actually together with number 5. First of all, it is lowering your risk if you have been putting $10,000 into stocks and you're getting 5% in dividend yield, meaning you're getting $500 out, that lowers your risk because now you actually have a lower exposure. In real life, you are only having 9,500 in risk in the market now because you have gotten 500 out. But also, and that's a point we are getting to later on, the dividend yielding stocks have less volatility, meaning that they are not fluctuating as much as normal stocks. I just found the numbers here, and as I said, we'll get back to these later. But the dividend has a beta of dividend-bearing stocks has a beta of 0.98, and that means that compared to the S&P 500, the dividend-paying stocks are actually a little less volatile. Compared to the non-dividend-paying stocks, they are a lot more volatile. When you have a beta of more than 1, it means that the stock goes up more than the market goes up, and it drops more than the market drops. So below 1, if you want a good stable portfolio, then dividend paying stocks are giving you less fluctuations in your portfolio. But this is just overall dividend paying stocks. This is not the Dividend Aristocrats that we are coming to in just a second. Very good. What are these Dividend Aristocrats? Well, as you might, the aristocrat shows something about elite or exclusivity. And first of all, to be an aristocrat, the stock has to be a member of the S&P 500 index. And you might know that, but that is an index of the 500 largest stocks in United States. But also, and here is the dividend part, they must have increased their dividends every single year for 25 years. So every single year, if we go back to the AT&T here, we can see that the dividends per share is $1.8, $1.84, $1.88, $1.92, $1.962, $2.03, and so on. If a stock wants to be a dividend aristocrat, it has to grow the dividend measured in dollars every single year. It might be so that the dividend yield is dropping, but that could be because if the stock price is going up with 20% and the dividend growth is only 2%, then the overall yield is dropping. But that is a technical issue. What people are wanting from these dividend aristocrats is they want to know that if they bought the stock in 2013 and got a dividend yield of something like 4% at that point, then that yield on the initial investment will go up over the year and hopefully more than the overall inflation. So it has to have increased dividends every year for 25 years. It has to have a market cap of at least $3 billion, meaning that that is the overall stock value on the stock market. And it has to have an average daily trade volume of at least $5 million, meaning that stock buyers and sellers must be exchanging stocks for at least $5 million each and every day on average the last 3 months up to the date where the aristocrats are calculated. So that is basically the dividend aristocrats. It is quite some harsh criterions, absolutely. And not many stocks are getting through. We have around 50, 54, 57 stocks that are aristocrats at any given time. But of course that changes from year to year. Now, is it profitable? Because what we want with our money, if we want to build some good, solid, stable earnings in the future, we want something that can at least do as well as the overall stock market. And if we look at the dividend aristocrats here, we can see some historical performance. This is a graph. I just found one here from 2009 and up to 19. And we can see that with the stock price gains and the dividends combined, the aristocrats over these 10-year periods made 13.7% per year. And the S&P 500 only, quote unquote, only made 12.4%. It doesn't sound like much, but if you have seen my video about compound interest, then you know that over a time span of 20 or 30 or 40 years, then 1.3% in difference can really mean a lot. But there are some other details here that we need to address. First of all, the reason why I took this chart here from 2009 is that the time frame from 2009 and up until now have been the longest running bull market in history. And I often address this when I talk to investors and communicate with them on Facebook and other platforms, because a lot of investors have started investing after 2009. And they feel like geniuses. There's an old saying that everybody is a genius in a bull market. And it has been a bull market more or less ever since the financial crisis in 2009. A few bumps on the road, but pretty much just upwards. So if you have invested in 2009 and been actively investing, it has been very hard to beat the market. Because when everything just goes up, we have a tendency of taking profits at all the wrong places and so on. But here, with the aristocrats, if you had just put all your money into the aristocrats in 2009, then you would be up way more than the overall market. So let's have a look at some other statistics, because this is just for the last 10 years. I have one here from 1991. Meaning that that is only till 2016 I found this stat, so this is 25 years. But here we can see also that the aristocrats are making 12.5% and the S&P 500 is quote unquote only making 10.3%. But here you can really see the difference, because after 25 years, a $10,000 investment, and we're not counting taxes and everything in here, would have given 116,000 in the S&P 500, and only 2.2% more over the 25 years would have given you $191,000 if you had put your money into aristocrats. So that is a huge difference. So it is worth to say that here, if you look up until 2000, 2001, where we had the large dot-com crash, we could actually see that the S&P 500 were doing a bit better. And that was because that everything went up so crazily quickly at that point. You might remember if you were in the market at that point, so that nobody really cared if the company were making money or anything like that. But then we saw the crash in 2000, 2001 and 2. And here we could see that the dividend stocks just started to pull off. Of course, they got a bit of a drawdown in 2008. But as we should see just in a second, it was actually way less than the overall market. And since then, it has just been going up. A very important thing here is that there is a lot of stability in owning the dividend aristocrats. I have something here called the aristocrat triangle. And I know it might be a bit small, but you might pause the video and maybe enlarge your screen a bit so you can see it better. But what this shows is that if you had started investing in the overall aristocrat index, and I'll get back to that later, but where you cover all the aristocrat stocks, if you have started with that in 2000, in the year 2000, and you had stopped in 2001, if you were only in stocks in this 1 year, in the aristocrat stocks, you would have made 10.8% per year, and that was only 1 year. If you had started in year 2000, but ended in 2002, where we had the dot-com crash, then you would have made minus 0.08%, meaning that even though it was a big market crash, you would actually pretty much break even. Did you keep the stocks until 2003, you would have made 7.78% per year in these 3 years, and so on. And on average, if you started in 2000 and kept going till the end of 2008, you would have made 8.15% per year altogether. Now, as you can see, there are some rather large differences. If, for instance, you started investing in the beginning of 2007, then we had the big financial crash, at the end of 2007, I think it is, yes. and you ended in 2008, you would have taken a loss at almost 22%. But had you held on to it for the 3 years, as we talked about before, until 2010, you would be up almost 6% per year, even though you just held your stocks straight through the great financial crisis of our lifetime. And if you had held them up until now in at the end of 2018, you would have had 6% on average. Here you can see the lowest number actually is 4.89%. So no matter what time period you are in here, you're pretty much making money. The only place, if you were really, really unfortunate and you started investing in 2006, then you would have held your stocks all the years through the big financial crisis, and you would actually over a 3-year period still be down with around 1% per year. But that is through the worst financial crisis that anyone can remember, except from 1929. So still, having started at the worst possible time, you would have made almost 5% per year. Okay, and you can see the numbers here in the later years where it has all gone up are actually quite great. So that is just to show something about the stability. And if we are looking at that crisis part of it, we can see here that if you have had the Dividend Aristocrats in the year 2000, just for the year 2000, you would have made 10.10%. But the S&P were down 9.10%, meaning that you outperformed. In a really bad crisis, you outperformed the overall market with 19%, meaning the difference between what you made in plus and what the S&P 500 had in minus. In 2001, you made 10.8%, but the S&P were down 11.9%, meaning that you outperformed the market with more than 22%. 2002, yes, the aristocrats were down 9.9%, but the market did minus 22%, so you still outperformed the market. 2008, as you know, was a really bad year, and the Dividend Aristocrats made almost minus 22%. That was a tough year. Indeed it was, but the S&P 500 was down 37%. And even though you were in minus, you outperformed the market with 15%. And one large part of being long-term profitable and beating the market in the long run is to be able to lose less in the crashes than the overall market. And as you know, might remember, 2018 was not a very good year. The S&P 500 lost just below 5%, and the Dividend Aristocrats were down a bit. So in that downturn year, the Aristocrats also beat the market. And as you might be able to see down here, you can see a percentage, how many percent from each sector are normally in the Dividend Aristocrats. And as you can see, we have 23% of them are coming from consumer staples, and 21% from industrials, and 12% from materials, and also from healthcare here, 11%. And that is normally the sectors, consumer discretionaries also, that is normally the sectors that are doing well when the markets are turning down. Whereas, for instance, the IT, the tech, normally are really beaten way down in the crashes, but there are not very many Dividend Aristocrats from that sector. So that's a part of it. If you're a bit of a numbers nerd, I have some more numbers for you, and I'll not go through them all, but you can just pause the screen here. But basically what this tells us is that we have the aristocrats here, and we have the overall S&P 500 here. And what we can see is that no matter if we're looking 1 year back, or 3 year back, or 5 or 10 or 15 or 20, we can see that the aristocrats are beating the S&P 500 in every single time frame. But as you know from my video about risk, is that we should not only look at the performance, we should also look at how much volatility are we taking on. Are we taking more fluctuation risk? And what we can see here is that on a 3 to 20 year scale, we actually have less volatility in every single instance. And as you also might remember from the risk video, I'll link to it below here, but as you might remember, then when we use the return divided by the annual volatility, we can get something called the Sharpe ratio. And the Sharpe ratio is a way to see if we are beating, if one investment is beating the other when we are adjusting for risk. And here we can see that the Sharpe ratio is higher than the S&P 500 Sharpe ratio also in every single instance. And that is good. We want a Sharpe ratio as high as possible. I know a lot of fund managers that would kill for a Sharpe ratio of 0.7 for instance. And here 7.7 is the worst period, but we are actually above 1 on a 10-year scale. So that is quite phenomenal, and this shows us that we could actually just put our money into Dividend Aristocrats and then do no more. We would not get 100% per year, no, but we would make a good and steady return. And a part of that return would be getting the dividends out. And it depends a bit on what country you're from, because in some countries there is some advantages in getting the dividends out because they are taxed less than just normal stock profits. And then there are other countries where it is actually a disadvantage. So you need to consult your own tax laws to see if it is more profitable for you than just having normal growth stocks that don't pay dividends. All right. How do we invest in this? Because that, of course, is the big question. 50 or 57, I think it is right now, of the largest stocks can be quite a handful to invest in. But of course, there are a couple of ways to do it on an automatic scale, and I'll show you that here. Because there's an ETF, and if you don't know what an ETF is, it stands for Exchange Traded Fund. And it is a very low-cost index fund, actually, a bit similar to a mutual fund. But it's very low-cost, and they are just working with very strict rules. So in this ETF called NOBL, funny enough, Noble, as in aristocrats, in this, I think the costs are only, let's just have a look here. I'm looking at the website called ETF.com. That is where I find all my information pretty much about ETFs. But you can just write Noble up here, or you can write Aristocrats, because there are a couple of other ETFs also doing this. But what you can see here is that it is US based. You can see the competing ETFs. There are some other ETFs that are kind of similar. You can read all the basic information here. You can see that there is an expense ratio of only 0.35% per year. It was started in 13, and it is actually almost a $7 billion assets under management ETF, which is quite great. If we go down here, we can see, and that is a good thing here, we can see on different focus areas if it is underweight or neutral or overweight. And we can see here that what we are looking for in the Noble is mainly quality. It is yield, cash flow paid out, and it is low volatility. And that is exactly what we just saw in the charts here. We can also see the growth. We can see here over the last, since 13 basically, we can see that it has just been going up, 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 and we can see all the performance stats down here. We can also see the top 10 sectors. That is pretty much what we saw just a second ago. The financials is a bit larger than I showed you. And we can see the top 10 holdings. Funny enough, the AppV is actually one of the stocks that I just recently did a Stock of the Week video about. So that is great that is here with almost 2%. So that is a way to do it. Another way is that if you want to be a bit more active in your investing, you can find a list, and that is easily, you can just Google Dividend Aristocrats 2020, for instance, and you will get a list of the Dividend Aristocrats. But you could find them, and you could go in here, and you could say, I want to be a bit more active. I might want to put some criteria up that I want to choose from. For instance, one of the things I would look at when I was looking at AT&T here, as you remember, I would like a good quality rating, meaning that I would like to see the earnings per share go up in a pretty straight line here. They have been a bit jumpy here, or a little bumpy, and that is not to my liking so much. What I also look at is something called the dividend cover, meaning that how many times can the earnings per share in a given year pay for the dividend. And what I don't like to see is that we have it's great to have a dividend at 1.84, but if the company is not making money enough to pay that dividend, then you're actually draining money out of the company. So if you have an earnings per share around 1.2 or 1.5 here, and you're paying out 1.8, then you are either taking out cash from the company that they could have spent on development, or you're borrowing money to pay the dividends with. So having a dividend cover below 1 is an absolutely no-go for me. I would like to see a dividend cover of at least 2, because that can ensure me that there is enough space, there's enough room in the company's economy to actually keep paying these dividends and keep raising them. And as you can see here, we're having 0.75, we're having 1.37. Here, trailing 12 month, we're down around 1 again. That was something that would probably keep me away from AT&T. If we look at Aptly, for instance, I don't remember the exact numbers here, but we can find them quickly. If we look at these, we can actually see that they're even lower. They are promising, and that's something that can be taken into consideration, because they are also down here 1.6, 1.6, 1.4, and so on. But with the estimates for 19 and 20, we can see that they are up around the 2 again, and that is something that will ensure me that they can keep paying out the good dividends. So there are a lot of different factors, but some of the factors I'm looking at is the earnings per share growing. I do like to see the PEG ratio here being very low. I mentioned that in all my analysis videos, but that pretty much just means that the price earning from the recent year divided by the estimated growth in earnings per share, when you divide these two, I like that to be below 2, because that means that I'm not paying too high a price for the future growth. Because even though it is Dividend Aristocrats, they can also be overvalued and they can fluctuate. So I do like to buy my Aristocrats, but I also like to buy them a bit cheap. But you know that from my normal videos where I discuss that. So the last point for today is just if you stumble upon some other expressions here. There are 2 other main expressions when we're talking about this Dividend Aristocrat area. One of them, let's just go here. One of them is Dividend Kings, and the other one is Dividend Champions. And it's a bit of the same. The Dividend Kings are just exactly the same as Dividend Aristocrats, but except from having raised their dividends for 25 years, they have raised them for 50 years. 50 years in a row, they have raised their dividends. There are not many companies that fulfill that criteria, but they are there. You can argue that it might not really matter if it is 50 or 25 years, because something that a company did 50 years ago, the products they had, the management they had, that is not really relevant, some would say, to the market and to everything today. Another thing is the Dividend Champions, and that is pretty much also like the Dividend Aristocrats. It's just from another analysis company, and what they do is that they are looking at 25 years straight increase in dividends, just as the Aristocrats. But they are not just looking at the S&P 500 stocks, they're looking at all stocks in the stock universe, pretty much in the United States. And there are some finer details about when they delete, how quickly they delete a stock from the list and so on, but that is details you can dive into by yourself. Now, the good question here is, these dividends, are they magic? Is it because of the dividends that the company goes up? My opinion is no. You could easily, well, I'm not sure how easily, but you could find strategies. I do have growth stock strategies that are doing quite as well, or even a bit better, but maybe with higher volatility. But the thing about the 25 years dividend increase in a row, that shows something about stability, and it shows something about really high quality of company products, of company management, really all of the both qualitative and quantitative fundamentals in the company. They need to be extremely strong to be able to increase dividend for 25 years in a row. So buying into the Dividend Aristocrats is a fairly safe way of getting high quality, low volatility, well-performing stocks that'll just keep going year after year after year. And of course, if they're deleted from the list, then if you're an active Dividend Aristocrat investor, then of course you should not invest in it. But if you choose the ETFs, they will automatically adjust for all of these details, and you can just put your money in there and pay a small fee every year, 0.35% in expense ratio, and then they will take care of it all. So if you want an automated strategy that has performed very well over the years, and even though over the last 10 years with the constant bull market has outperformed the market, then the Aristocrats might just be it. And as we know from the slide with all the risk, then if we are to see a big downturn in the market, nobody knows if we are, but if we were to see a big crash, there is a big historical proof that the Aristocrats would actually also do quite well under these circumstances. Of course, as I should also always say, I'm not a financial advisor, and as I say, past performance doesn't equal futures performance, etc., etc. You know the drill. But if you want something that has proven itself historically, the Dividend Aristocrats is a good choice. That's all for me now. I will track some of the Aristocrats, and I will make some videos about it in the near future. Talk to you soon. Take care of your money out there. Bye for now.